Good morning, everyone. Today, I'll be presenting my analysis of how the 2026 US-Israel-Iran conflict affected global financial markets and how that shock traveled into Singapore's financial system. The short version of my argument is this. The world got a severe energy and inflation shock, but Singapore's experience was surprisingly mild. And understanding why tells us a lot about how Singapore's exchange rate-centered framework actually works. Let's begin. So, first, some quick context. On the 20th of February, 2026, the US and Israel launched large-scale airstrikes on Iran's nuclear facilities, military sites, and senior leadership. Iran hit back at Israel, US bases, and the Gulf states. But the move that mattered most for markets was the closing the Strait of Hormuz. That's the channel that normally carries about a fifth of the world's seaborne oil and LNG. And the timeline after that. A Pakistan brokered ceasefire on the 7th and 8th of April, a US naval blockade from the 13th, and a memorandum of understanding to end the war on the 14th of June, and a brief flare-up in early July. So, why Singapore? 3 reasons. It imports nearly all of its energy. It's one of the most open economies in the world and a major oil trading hub. And its financial center is deeply plugged into global capital markets. If any small economy should feel this shock, it would be Singapore. Let's start with the most direct channel, oil. So, as you can see, Brent was sitting at about $72 the day before the war. Within days of the Hormuz closure, it topped 80, a jump of more than 10%. As the closure dragged on, it kept climbing, past $100 by late March and above 110 by early April. One detail worth noticing, WTI actually traded above Brent, which is unusual, and it happened because buyers were paying a premium for barrels they didn't have to pass through the Gulf. Then look at what happened on the 8th of April. The ceasefire was announced, and Brent fell almost 16% in a single session, to around 92. By June and July, it was back in the low 70s. The takeaway, prices moved on what markets feared could happen to supply, not on what markets feared, not what actually lost, sorry. That's a forward-looking risk premium, and it can unwind as violently as it builds. The oil shock repriced everything else. 3 numbers tell the story. So firstly, the US 10-year Treasury yields hit 4.46% by late March, with the 2-year up 60 basis points to 4%. Markets went from expecting Fed rate cuts to pricing a possible hike. The VIX spiked above 35 on the 9th of March, its highest since the tariff sell-off of April 2025. Yet, the S&P 500 fell only about 3.6% from the start of the strikes, a sharp but shallow, which sort of fits the historical pattern for geopolitical shocks. Underneath all that, gold rallied. The dollar index rose about 2.5% back above 100, and credit spreads widened from tight levels. So, Singapore faced 3 shocks at once. In oil terms of trade shock, higher world rate interest, and a global risk of impulse. Now here's where it gets interesting. Because Singapore's markets did not behave the way emerging markets usually do in a crisis. Start with the currency. While most Asian currencies fell against a strengthening US dollar, the Singapore dollar was one of only 2 Asian currencies that gained. It traded about 1.28 to the dollar in early April, near an 11-year high. And the trade-weighted S-dollar NER set in the upper half of its appreciating policy band. Why? Capital came in, not out. The local banks DBS, OCBC, and UOB saw falling loan-to-deposit ratios and rising assets under management. And Gulf wealth actually relocated to Singapore as the war damaged hubs like Dubai. The mechanism is credibility. Because markets trust MAS to defend the band, stress abroad pushes market into the Singapore dollar. That's the exact reverse of the usual emerging market pattern. Those inflows show up clearly in the bond and money markets. While US 10-year yields were surging about 4.46%, Singapore's 10-year government bond yield fell to about 2.23% in late March. because even demand for AAA rated Singapore dollar paper went up. And 3-month SORA set near a 3.5-year low of 1 to 1.2%, even as global rates rose. Two bits of theory explain this. Firstly, a widening negative yield gap against the US only makes sense under uncovered interest parity if investors expect the SGD to keep appreciating, which is precisely what MAS policies deliver. And it's the possible trinity in action. With an exchange rate target and an open capital account, Singapore doesn't control its interest rates. Flows set them, and in this episode, flows push them down. The stock market tells the same story. So, as you can see, the Straits Times Index hit a record of 4,995 on the 2nd of March. In the first week of war, it fell to about 4,890, a drawdown of just about 2%. It bounced within days, jumped almost 1% on the ceasefire, and by the 3rd of June, had set an all-time high of above 5,150, up about 26% over 12 months. Underneath the COM index, sectors split sharply. Defense and engineering and shipbuilding gained. Airlines were hit by fuel costs, property, and the banks initially lagged. The index held up partly because of what it's made of, heavy in banks and dividend payers, light in the tech names that were hit hardest globally. So what did MAS do? On the 14th of April, it tightened, the first central bank in Asia to move after the war began. Specifically, it slightly steepened the appreciation path of the S-dollar NER band by an estimated 50 basis points to around 1% a year, leaving the width and center unchanged. It also raised its 2026 inflation forecast to 1.5 to 2.5%. I argue this was the right tool for the shock. A stronger Singapore dollar lowers import prices directly in an economy where imports touch almost everything consumers buy. That's more direct than an interest rate. MAS also signaled that it stands ready to curb excessive volatility, a clear intervention warning. And fiscal policy did the other part of the job. A support package of almost $1 billion Singapore dollars cushioned household incomes. The fair critique is that tightening a supply shock risks the growth side, and Q1 did contract quarter on quarter. But the move was deliberately small, and on balance, I think the calibration was sensible. So why could Singapore absorb all of this, the buffers? That's the answer. Official reserves stood at about 420 billion US dollars at end March. And here's the telling detail. They rose to about 427 billion by end April. That means that MAS wasn't defending currency. If anything, it was restraining appreciation. The banks are among the best capitalized in the world and gained deposits through the crisis. And because MAS is both the central bank and the regulator, whole response consisting of the monetary policy, intervention, supervision, communication, all came from one coherent institution. The vulnerabilities that remained aren't financial. They're real. Imported energy and food, and the maritime cluster's exposure to shipping choke points. So, to wrap it all up, the world got a severe shock. Oil from 72 to above 110. The VIX above 35. A global bond sell-off. Singapore's experience was mild. Stronger currency, capital inflows, falling bond yields, a 2% equity dip before new records, and an early, credible policy response. 3 implications. First, Singapore's exchange rate framework works through credibility. Communication matters as much as the setting itself. Second, because domestic rates fall in risk-off episodes, financial conditions ease at exactly the wrong moment. So macroprudential vigilance has to compensate. And third, the binding constraint this crisis exposed was real, not financial. Energy diversification, stockpiles, and trade routes deserve the next dollar of investment. Thank you very much.